Greetings, D7 here with freetrainingvideos.com. And we're going to be talking about your retirement account. And specifically about your retirement account in a bear market. No fun to think. We are in fact in a bear market, and we know there's been blood in the streets. You can't turn on the TV and listen to any of the talking heads in the media to know that we haven't been down. Markets have actually been down 35% going back a year from October 07, October 08, 35% haircut. The question is, we're down 35%. Should we hold or not hold? Well, here's the bottom line. Recession is on everybody's lips right now. The big R word, recession. Recessions are bad, and bad things come. Government has been doing unprecedented measures, taking steps that they have never taken before for one purpose: to shore up the markets, to shore up confidence. That helped this credit crunch we've been in. The markets have been crashing so bad that we've been seeing the biggest single-day drops and weekly drops than we've ever seen in history. The markets have been and are very bad. Now, let's talk about your specific 401k or any of your retirement accounts that you might have. Now, just me bringing it up makes you want to drink Maalox. Your stomach's upset, and it's just bad. My heart, particularly breaks for the baby boomers that are out there, seeing their accounts whittle away to nothing, and you're ready to retire. Or you're already retired, and you're really worried about what's coming next. Now, I want to talk a little, about some different instruments or vehicles that you might be in right now. Most of you are in mutual funds. So let me say this up front. Let me be just kind of blunt. You won't catch any of my retirement positions in mutual funds. Let me tell you why. In 2007, here's a statistic. I want you to hear what I'm about to say. In 2007, the average mutual fund did worse than the broad markets by 2.7%. 3%. The average mutual fund lagged the broad markets by 3%. Now that's no good. If the markets were down 35% for the year so far, and that's just so far, 35%, if you were holding mutual funds, what would you be down? You'd be down roughly 38%. That's not even calculating in inflation. Inflation is usually 3 to 4%. The last 2 years it's been 4%. Add another 4% to that. We're talking over 40% down, and you see it. It's no secret. Look at your retirement accounts or those broker statements when they come in quarterly. You're not going to like the next quarters. It's going to be worse. It is. Exchange traded funds is something else you might be in. Actually, there's been a huge exodus, a big movement going from mutual funds into ETFs the last 10 years, especially the last 5. Now, why? Why has that been? Because exchange traded funds don't come with the beefy, hefty, huge fees that mutual funds come with. Now, yes, I said fees. That's why they lag the market. Mutual funds lag the broad markets by nearly 3%. And by the way, that's my conservative number. There's other numbers that says it's more than 5% that the average mutual fund has lagged the broad markets. But I'm being very conservative and saying 3%. It is a fee. Who charges that fee? The broker. The products that brokers sell. Brokers sell mutual funds. If you hold a mutual fund, you're going to be out about 3% each and every year you hold that thing. You're going to be lagging the broad markets. Exchange traded funds are products, but they are traded like stocks at the exchange themselves, not at the brokerage firm. Now listen, ETFs are much like mutual funds. Same thing, but just less of a fee or a cost. So that's why a lot of people have been going to ETFs. ETFs would be like the spiders or diamonds or the Qs, QQQQ. And individual stocks in a bear market is very risky, not at all recommended. Every stock out there is dropping. Why? Because it's like this. When the tide drops, all the boats in the harbor drop. And the stocks will take a hit also. Now let's talk about your broker. Because after all, your broker is in a position to actually safeguard your money. Is that right? No. Every quarter, you grimace when you open up your quarterly statement. They are not there to protect you. Actually, my father-in-law tried to get out of his. He called up his broker and says, hey, I'm feeling a lot of pain here. I just want out of this mess. Help me, help me, help me. Broker says, oh, stay the course. Stay the course. Now, why would he recommend to stay the course in a bloody bear market? Why would he do that? Because he gets paid on what? Those products. If you stay the course, he gets paid. If you're out of it, does he get paid? No. Matter of fact, if my father-in-law decided to keep his money in the markets, and they would be way down right now, if he would have kept them in there, who would have taken that hit? It wasn't the broker. My father-in-law would have taken the hit. So, whose responsibility is it to get in and out of the markets at certain times? It's yours. Your financial advisor is not going to do it for you, and your broker's not. Now, why? I think, is it because they don't want to see you succeed? Because after all, they say diversify, diversify, diversify. There's safety in that. Is that? That's like tying yourself to a millstone and jumping off of a ship. The more you're diversified, the more you're just going to go down with the markets as it crashes. It's very uneducated. Staying the course is very uneducated. I don't want to be sitting on a boat that's on flames and sinking just because I had a broker tell me so. Yeah, they're all selling products. They're all selling products. You have to understand that. What we have to do is be smarter than our broker. It's not hard to do. They come to me and I teach them trading. I teach them when a chart goes up, that's good. When the chart goes down, that's also good. Did you know we make money when the markets go up and down? Brokers only try to make money when it goes up. Opportunities. Learn to protect your money first. It is your responsibility to protect your portfolio. That's your retirement fund. Do you think you got a broker? You're just one in hundreds of people that they deal with. You think they're going to care about your account like you do? No. What you have to do is say, that's my retirement. That's my livelihood tomorrow. I need to better position myself to manage that myself. Is it hard? No. My 5-year-old can see a chart going up and she'll say, oh, the chart's going up. Yes, that's a very good thing. Or, hey, the chart's going down. My 5-year-old knows that we make money when the markets go up and down. She's 5 and can see when the chart does this. Now, we're all adults here. We need to be positioned in such a way to look at a chart to be able to know if the markets are going up or going down. We need to learn to find the best opportunities out there. Listen, when the markets go bullish, and they will at some point, they will go bullish again. It is great to understand if you have a strong company or a bad company and how to find that. Take full advantage of a market, either in a bull market or a bear market. Take full advantage of that. Learn what your brokers have not learned. It is your responsibility. Start today. Don't hesitate. Don't think that I'll come to it later or the markets will bounce later. You don't know that. You don't know what the next year has. It is today. Today is the day. Now, where can you go? Go to freetradingvideos.com. Watch all the videos you can. You're not going to understand half of what we're talking about. You don't have to. Just start looking at those charts and see them going up, how we make money, see them going down, how we make money. And you will start understanding that, this isn't overly all that complex or intimidating. Get in, learn. Get in and learn. freetradingvideos.com. Hope to see you there. Take care.